This is your lesson on bonds. I'm working problem 14-2B on page 661. There is a lot of information on bonds, but if you take it step by step, you can understand bonds. I'm not going to read the whole entire problem to you. We're just going to work it as it comes along. So the first thing that they ask us to do is to journalize the entry to record the amount of cash proceeds from the sale of the bond. I always like to deal with cash first. So if we're issuing bonds, we're giving investors bonds, a payable, and we're getting cash. They're giving us their $1,000 or $5,000. So if we issued bonds, they tell us up in the problem that we received cash of $31,595,241. So when we build our journal entry, we're immediately going to know that we get cash of $31 million. If we're receiving cash, cash is debited because our cash is increasing and cash is an asset. Assets are increased with debits. Just a reminder. Okay, let's build the rest of the journal entry. We issued bonds, thus we now have to put a payable on our books. We now owe these investors this money. We're going to pay them interest and then eventually give them back the face amount of the bond. Bonds payable is always, always, always recorded at the face. So build that part of your journal entry. We know we're putting a bonds payable, which is a liability, on our books for the face amount. Do you see the face amount is the $34 million, which is different from our cash. So what's wrong? Oh, our debits and credits don't balance. That makes us sad. What are we out by? We're out by $2,404,759. Think about it. We received less cash than the face amount of the bonds. We only received $31 million when the bonds had a face value of $34. So we had to reduce the price of our bonds or discount it. So that's when you record a discount. A discount is simply the difference in the purchase price and the face amount of the bonds. So we've got our journal entry. Yay! That wasn't so bad. Now let's move down to journal entry number 2. It says journalize the first semi-annual interest payment on December 31st using the straight line method. Okay, the bond discount is actually additional interest the company has to pay. Think about it. We only received $31 million and yet we owe $34. So we're paying an additional $2 million in interest. Keep that in mind when you're working this. Okay, to the calculation. How many times will the bond pay interest over the life of the bond? Because we're supposed to amortize it over the life of the bond. Well, it's a 20-year bond, and it's paid semi-annual or twice a year. So twice a year for 20 years gets us, we're going to pay 40 payments of interest every June and every December for 20 years. So 40 is the number that we need. So we're taking that discount, that difference between the purchase price and the face value of the bonds, and we're going to divide it by the 20 years times semi-annual, and we get $60,000. Okay, one more calculation and then we'll get to our journal entry. Okay, what is the interest the bonds are required to pay based on their stated rate? Go back up and look. The stated rate says the bond should pay 12%. So we're going to take the face value of the bond times the stated 12% times they're paying it every 6 months out of 12. Okay, remember you use 6/12 there. That's principal times rate times time. Time is always expressed in a year. If this had been an annual interest payment, it would have been 12/12 because they pay interest every 12 months. Okay, this is very important when you're calculating what the bond is required to pay. You use the face amount, not the issue price, and the stated rate of interest. Whew, looks like a lot of calculations. Okay, finally, let's build the journal entry. Yay! Okay, cash is always what the stated rate on the bond is times the face times the time. Okay, we just calculated that. So that's the cash we are legally obligated to pay out in interest every 6 months. So if we're paying out cash, we're crediting cash. Okay, then we also calculated our discount to be $60,119. If you go back to your first journal entry, you'll see that your discount was debited So we want to reduce that discount now, so we're going to credit that discount to get it off our books by the end of the 20 years. So you're just taking a little chunk of that discount off every time. Once again, our debits and credits do not balance. Ooh, we need some debits. So where is all of this going? What does all of this represent? It's interest expense on our books. Okay, so to balance, we just put everything to interest expense. Note that the cash paid out is not the same as what we're expensing in our books. It's more because of the difference in the issue price and the face amount of the bond. Okay, our final part B says, what about the June 30th entry? That journal entry is going to be the same every 6 months for 20 years. It's always going to be the same cash because the face doesn't change, the stated rate of the bond doesn't change, so cash is always going to be the $2,040,000. Your discount won't change, it's always going to be divided by 40, that's always going to get you $60,119. So if I ask you what is the June 30, 2020 journal entry, it would be the same. Part 3 says determine the total interest expense for 2012. They just want you to realize the interest expense is not the same as cash in accounting. So our interest expense is the $2,119,119. Question 4 says, will the bond proceeds always be less than the face amount of the bonds when the contract rate is less than the market rate of interest? That's a lot of words with a lot of lesses and a lot of greater thans, so I have to put numbers with it. Okay, spoiler alert, the answer is yes. But let's look. The market rate is 13, that's a nice high rate. Our stated rate is 12%. That's lower. So the question says, the contract rate is less than the market rate. So that's what we have. So we have a contract rate of 12 and a market of 13. They're asking, will we always receive less than the face amount? Yes. Think about it. Who wants our low interest paying bond? Investors could go elsewhere and get a higher rate. Thus, we will always have to discount it. Think about that dress that you see across when you're shopping. You think, it's kind of cute. You walk over and it's 75% off. You then buy it. Why? Because it becomes more attractive because it's a lower price. So even though our bonds are a lower interest rate, we make them more attractive by discounting them from the $34 million regular price to the discounted price of $31 that we actually receive in cash. Yay, I think y'all are getting bonds. Okay, this is the funnest part of bonds. We're calculating the actual issue price. They told us in the problem that the issue price was $31,595,241, but let's calculate it for fun. When you're calculating the issue price, you're dealing with two numbers. The face amount, which you know is the $34 million, bonds payable, and the interest that they are required to pay. Remember, that's the principal times the rate times the time. Alright, you're also going to use the present value tables. Those are located in the very back of your book in Appendix 2 and page Appendix 4. So A-2 and A-4 in the back of your book. Alright, so which table do I use? There's a million tables back there. The face amount of the bond is only going to be repaid once. So that is a single sum. That's going to be at the end of the 20 years, we'll give the face amount back to the investors. So we're going to use the present value of $1 or single sum tables on A-2 when we're dealing with the face. The interest, however, is paid every 6 months for 20 years. So 40 payments are made. We will use the table on A-4, the present value of an annuity. An annuity just simply means it's a steady stream of payments. We're paying interest every year. So we're going to use the annuity table when we're dealing with interest. How do I use the table? When you go to the table, you will always use the market rate of interest. Market. So first you need to calculate the number of periods. We said it was a 20-year bond, semi-annual payments. So that gives us 40. Interest rate, you take the market rate and you divide by 2 because it's paid semi-annually. Again, if this was an annual payment, so they paid interest only on December 31st, it would be 20-year bond times 1, So your number of periods would be 20. And it would be 13% divided by 1, which would give you 13%. If it was quarterly payments paid every 3 months, it would be 20 times 3, 4, there's 4 quarters in a year, so that would be 80, and it would be 13% divided by 4. Okay, so our bond is 20 years semi-annual, so our number of periods is 40, and our interest rate is 6.5 because it's every 6 months. So we deal with the face amount times our factor. We got that factor from the present value of 1 table on A-2 using periods of 40, come down the side of 40, and then go across to the interest rate of 6.5%, and that's the factor it gives you. So we multiply that out and get 2.7 million. We do the same with interest. However, we're using the annuity table because it is a stream of payments. On periods 40, and the interest is 6.5%. So it gives us 28 million. So to get the final value of the bond, we take the face amount that we calculated plus our interest of 28 million, and we get 31,595,241. Does that sound familiar to anybody? Yay! That amount agrees to what was given to us at the proceeds in part 1. So you know you did your information correctly. Kudos to you for making it through the lesson on bonds. You should make a family member watch this so that they will have a deep appreciation of the accounting that you are learning.